Let's talk about where you are putting your money. Where is opportunity when everyone else seems to be cautious? Everyone's focused on the banking crisis. Everyone's focused on an economic slowdown. Are you putting money to work right now?
We are.
Yeah.
It started. I don't want to overdo it, right?
Yeah.
So just in context, in a good year, we'll invest $6, $7, $8 billion a year. Last 9 months of 2022, we invested a little bit more than $1 billion. We really pulled in.
Wow.
First 4 months of this year, it's starting. We've invested $1 billion too in 4 months. Not at the 6 to 8 billion pace at all. I do think the pace is going to pick up, but for us, you know, this grinding market we've been in,
right?
It started to open up the opportunity pipeline, and it's all across, Romaine. It's not just in the debt you can buy at a good price.
Right.
It's also in assets like airplanes or infrastructure. You can buy at a good price. It's much broader.
Well, you run the type of business that's supposed to do well, or at least find good opportunities in down markets, in down economies here. How does what we're in right now compare to some of the other recessionary cycles that we've been through?
Yeah, you know, I've been in this business for 30 years. And I've been through 6 different cycles. All the cycles are a little different, but they do rhyme.
Okay.
I think this cycle is much closer to 2002. So when I look back, like even after 2008, the recovery was sharp. Oil and gas crash, COVID, it was almost like we only touched the bottom briefly, right? Very sharp recoveries. The one we're in today feels much more like the Fed is not your friend.
No, it's not.
It's raising rates to fight inflation. The ECB, which is much more dovish, is doing even the same exact thing. I think our point of view, this is a grinding down and a grinding up. It's a 3-4 year cycle, much more like 2002 than any of the things we've experienced since then.
With that length of a cycle, that means there are a lot of folks that aren't going to survive it. They're just not built to go that long with those types of conditions. What areas would you avoid?
You know, I know as a opportunistic credit investor, I can sound brave. We are not that brave, okay? So when we look at the world, a whole bunch of stuff in emerging markets. You know, just the way bankruptcies and restructurings work, not for us. We have 40% of our businesses in Europe, but there are large parts of Europe, like Italy, like Eastern Europe, not really for us. And then there are quite a few different industries we don't really care about, right? So, like, you take a business in secular decline, like the paper business, the old Yellow Pages business, not for us. We're not that brave.
Okay. The news business? Don't answer that. I am curious, when we talk about the opportunities, though, from a structural level. There's been so much talk, of course, about the persistence or the stickiness of something like software, particularly those companies that have recurring revenue streams. There's been a lot of talk, of course, about artificial intelligence and whether that's now become an investable space, not just a place for hype.
You know, for somebody like us, we are much more an old economy, hard asset investor. So the sort of stuff we look at, quite different than the sectors you talked about, because a lot of that stuff never really becomes so distressed or requires a lot of intervention operationally. So the stuff we focus on are industrial businesses, packaging businesses, TMT businesses, service businesses. So for us, it's much more that ilk of investment. In this coming bust, there'll be more stuff around office property, but it's much more that world, which is the one we are focused on.
What type of returns, though, do you expect out of those types of areas, particularly given the economic conditions?
We don't really get out of bed unless we think we can make 20% plus IRRs. And for us,
and has that gone up? I mean, given that we've gone up from 0% on the Fed funds rate to whatever it is, 4.75?
Absolutely.
Okay.
Right? It is, but I think even besides looking at those kind of returns, the other thing which is important to us is the multiple. 20% IRRs for 2 years in a fund is a 1.3 net multiple. Just not that interesting. What we do, we take a third of our businesses, taking control of businesses, intervening, fixing them, improving them, and when we do that, we can make many multiples of our money. And so for us, the focus is, sure, in a cycle like right now, we'll do some of these 20% rate of return deals, 1 or 2 year investment lives, but it's that other stuff which also really powers our returns, powers what we do.
Is your business, the business itself of Strategic Venture Partners, is that expanding? Are you hiring? What's going on internally?
We have been hiring.
Yeah.
We've been building up to this cycle. So we had 40 or so investment professionals 3 years ago. We have 80 now. We've hired a lot more operating partners as we take control of businesses to intervene, to help fix them. That's been one place in particular we've hired. Our assets under management have almost doubled. Half of it is profits, okay? It's not just AUM gathering, which we're doing, but yes, we've had good growth.